Welcome to Lesson 2 of Week 9. Building on our overview of cost sharing, this lesson focuses specifically on valuing in-kind contributions. In-kind contributions are non-cash resources donated to your project, and they must be valued according to federal standards to count as cost sharing. Proper valuation is both important and challenging. You cannot simply assign whatever value seems convenient to donated resources. Federal regulations establish specific standards for determining the value of contributed time, space, goods, and services. Failing to follow these standards can result in disallowed match and compliance problems. This lesson will help you understand the regulatory framework for valuing in-kind contributions, specific valuation rules for different types of contributions, documentation requirements for supporting valuations, and common valuation errors to avoid. The regulatory references in this lesson were accurate as of November 2025, specifically 2 CFR 200.306 paragraphs D through H. As always, verify current requirements at ecfr.gov before making valuation decisions. By the end of this lesson, you will be able to apply appropriate valuation methods to in-kind contributions and document your valuations defensibly. In-kind contributions are non-cash resources contributed to your project. Unlike cash cost sharing where your organization actually spends money, in-kind contributions involve resources provided without direct payment from grant or organizational funds. Common examples include volunteer time, where individuals contribute professional or general services without compensation. Donated space covers facilities provided at no charge for project activities. Contributed equipment includes items loaned or donated for project use. Donated supplies and materials include consumables provided without charge. Each type has specific valuation considerations. For cost-sharing purposes, these contributions must be assigned a monetary value. You cannot simply describe contributions qualitatively, you must quantify their worth. This valuation allows in-kind contributions to be counted toward match requirements alongside cash contributions. Federal standards govern how valuations must be determined. You cannot assign arbitrary values based on what you wish contributions were worth or what would be convenient for meeting match requirements. Regulations establish specific methods for determining fair value. Following these standards ensures your in-kind match will count and withstand audit scrutiny. Several general principles guide valuation of all types of in-kind contributions. Understanding these principles helps you approach specific valuation situations correctly. Fair market value is the foundational concept. Contributions should be valued at what they would cost if you had to purchase them. If donated space would rent for $2,000 monthly in the local market, that is its fair value regardless of what you might wish it were worth or what would be convenient for your budget. Consistency requires applying the same valuation methods to similar contributions. If you use one approach to value volunteer professional time, use the same approach for all similar professional volunteers. Inconsistent methods raise questions about whether valuations are arbitrary or manipulated. Reasonable basis means valuations must be supportable with evidence. You should be able to explain and document how you arrived at any value you claim. What market data supports your rate? What comparable transactions inform your valuation? Defensible valuations rest on evidence, not assertions. No inflation means you cannot overvalue contributions to meet match requirements. The temptation to inflate values to close match gaps creates serious compliance risks. Auditors examine whether valuations follow proper methods. Inflated valuations constitute false claims that can result in significant penalties. Volunteer services are common in-kind contributions that require careful valuation. The key is valuing the service provided, not the person providing it. Professional services contributed by volunteers should be valued at the rate you would pay for the same service from a contractor or employee. If a licensed accountant volunteers to maintain your project's financial records, value their time at what you would pay an accountant for that work. The volunteer's actual compensation in their regular job is not the relevant consideration. General services not requiring specialized skills should be valued at rates appropriate for that type of work. If community members volunteer to help with event logistics, value their time at rates for event support staff, not at executive rates just because some volunteers happen to be executives in their day jobs. The critical point is that value depends on the service provided, not what the volunteer earns elsewhere. An executive earning $300 per hour who volunteers to stuff envelopes provides a service worth perhaps $15 per hour. A retired professional providing specialized consulting for free contributes at consulting market rates. Match the valuation to the work performed. 2 CFR 200.306 paragraph E establishes requirements for valuing volunteer services. Review this regulation for specific requirements and verify the current text at ecfr.gov. Proper documentation of volunteer time ensures your in-kind match is defensible. Build documentation systems that capture necessary information systematically. Time records should document hours contributed by each volunteer. Simple timesheets or logs that capture dates, hours, and a brief description of activities provide the necessary foundation. Without hours documented, you cannot calculate a value regardless of how appropriate your rate might be. Activity descriptions record what tasks were performed. This information connects to rate determination, since the appropriate rate depends on the type of service. Noting that a volunteer provided accounting services versus event support allows you to apply the appropriate rate for each type of work. Rate basis documentation explains how you determine the hourly rate used for valuation. Did you research local market rates for similar services? Did you use a recognized survey or rate schedule? Did you determine what you would pay for a contractor to provide equivalent services? Document your methodology. The calculation is straightforward. Hours times rate equals claimed value. If a professional volunteer contributed 40 hours at a rate of $75 per hour based on local consulting rates, the claimed value is $3,000. The documentation should make this calculation transparent and verifiable. Donated space, such as meeting rooms, office space, or storage facilities provided at no charge, must be valued at fair rental rates. Understanding how to establish fair rental value ensures your space contributions count. Fair rental value is what comparable space would cost to rent in your local market. If a community center provides free meeting space for your project workshops, the value is what you would pay to rent equivalent space elsewhere. Research what similar venues charge for similar space. Market comparison research establishes fair rental value. Look at what local facilities charge for comparable space. Consider factors like size, amenities, location, and typical rental terms. If a partner provides space that would rent for $200 per day at comparable venues, that is your valuation basis. Square footage calculations may be appropriate when space is shared or when full facility rates do not apply. If you use one room in a larger facility, value that room rather than the whole building. Calculate value based on the space you actually use for project activities. Time period valuation ensures you claim value only for periods actually used. If you use meeting space for 3 workshops over the year, value those 3 occasions rather than claiming ongoing rental value. Document when space was used and for what project purpose, then calculate value accordingly. Equipment donated or loaned to your project can count as in-kind cost sharing when properly valued. Understanding equipment valuation principles helps you claim appropriate values. Fair market value means the current value of equipment when donated, not what it originally cost. A computer purchased 5 years ago for $2,000 might have fair market value today of only a few $100s due to depreciation and technological obsolescence. Value what the equipment is worth now. Depreciation must be considered for used equipment. Items lose value over time through wear, technological change, and market conditions. An accounting estimate of remaining useful life and depreciated value provides one approach. Comparison to market prices for similar used items provides another. Professional appraisal may be needed for significant items. If someone donates specialized laboratory equipment worth substantial amounts, a professional appraisal documents fair market value defensibly. The cost of appraisal is worthwhile when the contribution is significant and valuation is complex. Usage allocation applies when equipment is shared between your project and other activities. If donated equipment will be used half for your project and half for other purposes, claim only half the value as project cost sharing. Calculate fair market value, then multiply by the percentage allocated to your project. Supplies and materials donated for project use can count as in-kind cost sharing. Valuation approaches vary depending on whether items are new or used. Fair market value at the time of donation determines the amount you can claim. For supplies that will be consumed in project activities, value them at what equivalent supplies would cost to purchase currently, not what the donor originally paid for them. New items donated soon after purchase may be valued at purchase price. If a business donates office supplies purchased last week, the invoice amount represents fair market value. Keep donation receipts or copies of purchase invoices as documentation. Used items must be valued at current fair market value, not original cost. If someone donates materials that have been sitting in storage for years, their current value may be significantly less than original purchase price due to deterioration, obsolescence, or changed market conditions. Be realistic about current value. Documentation from donors helps establish value. Donation letters indicating what was contributed and estimated value, accompanied by purchase receipts or other evidence, support your valuation. Ask donors to provide documentation when they contribute supplies or materials. When partners, donors, or community sources provide in-kind contributions, the same valuation standards apply as for your own contributions. However, working with external parties adds complexity to documentation and verification. The same federal standards apply to third-party in-kind contributions as to your own. Volunteer time from partner organizations, space donated by community venues, equipment contributed by businesses, all must be valued following the same methods discussed in this lesson. The source of the contribution does not change valuation requirements. Donor certification provides documentation from the contributing party. Ask donors to provide written statements describing what they contributed and their estimated value. This certification becomes part of your cost-sharing documentation. Contributions without donor documentation are difficult to verify and defend. Value verification means checking that the donor's stated value is reasonable. A business might claim their donated equipment is worth $50,000 when fair market value is actually $10,000. You cannot simply accept stated values without review. Verify that claimed values align with market reality. Your responsibility means you are accountable for valuations you claim as cost sharing, even when contributions come from third parties. If you claim inflated values based on donor assertions, the compliance problem is yours. Review third-party contributions critically and claim only defensible values. When donors contribute resources to your project, they may seek tax benefits for their contributions. Understanding the intersection of IRS requirements and federal grant requirements helps you navigate potential confusion. Donors may claim charitable deductions for contributions they make to qualifying organizations. If a business donates equipment to your nonprofit, they may deduct its value on their tax return. This tax benefit may motivate donor generosity. IRS valuation rules for charitable deductions differ from federal grant cost-sharing rules. The IRS has specific requirements for substantiating donations and determining deductible value. These requirements are not identical to the valuation standards in the Uniform Guidance. Donors sometimes conflate these different frameworks. The tax implications are the donor's responsibility, not yours. You need valuations that satisfy federal grant requirements for cost sharing. Donors need valuations that satisfy IRS requirements for their deductions. These may or may not be the same. Help donors understand you are applying grant-required methods. Their tax advisor can address deduction issues. IRS appraisal requirements apply above certain thresholds for non-cash contributions. Donors claiming significant deductions may need qualified appraisals. These appraisals might also support your cost-sharing valuations, but confirm that the appraisal method aligns with federal grant requirements. Documentation requirements for in-kind valuations ensure you can demonstrate the basis for claimed values. Building comprehensive documentation from the start supports audit defense. Records for each contribution should document what was contributed, when the contribution occurred, from whom it came, and the value claimed. This basic information establishes the essential facts. Organize records by contributor and contribution type for easy retrieval. Rate basis evidence supports the rates used for valuation. If you used a particular hourly rate for volunteer professional services, document how you determined that rate. Market surveys, comparable billing rates, salary data for similar positions all can support your rate determination. Third-party certifications provide written statements from donors confirming their contributions. Ask donors to provide letters or forms describing what they contributed and when. For significant contributions, donor certifications should include value information and the basis for stated values. Retention requirements specify how long you must maintain cost-sharing documentation. Federal grants typically require retaining records for at least 3 years after submission of final reports. Maintain organized files that you can access if questions arise during or after the project. Electronic records should be properly backed up and accessible. Common valuation errors create compliance problems that careful attention can prevent. Recognizing these mistakes helps you avoid them in your own cost-sharing management. Inflated rates mean using values higher than fair market supports. The temptation to overvalue contributions to meet match requirements is understandable but creates serious risk. If you claim professional volunteer time at $300 per hour when market rate is $150, you have overvalued by half. Auditors catch these inflations. Inappropriate rates value work at the wrong skill level. An executive who volunteers to perform clerical tasks should be valued at clerical rates, not executive rates. A professional providing general services should be valued for those general services, not their professional specialty. Match rate to activity. Missing documentation claims value without adequate support. Verbal assertions about contributions are not sufficient. Without time records, donor certifications, market research, and other supporting evidence, valuations cannot be verified and may be disallowed. Original cost errors use purchase price instead of current fair value. Equipment donated years after purchase, supplies that have sat in storage, items that have depreciated or become obsolete, all must be valued at current fair market value. Original cost is not the relevant measure for donated used items. Effective tracking of in-kind contributions requires systems and procedures that capture information consistently throughout your project. Good tracking prevents problems and ensures you can demonstrate your match. Establish consistent tracking methods from project start. Create templates for volunteer time logs, space usage records, and donation documentation. Assign responsibility for collecting and organizing records. Define procedures for how contributions will be recorded and valued. Real-time recording captures contributions when they occur. Do not wait until reporting periods to figure out what volunteers contributed months ago. Build recording into regular activities so documentation happens contemporaneously. Monthly collection of volunteer hours is far more accurate than annual reconstruction. Regular review verifies documentation completeness. Periodically review your cost-sharing files to identify gaps or incomplete records. Are all volunteer timesheets collected? Are third-party certifications obtained? Catching gaps early allows you to obtain missing documentation before it becomes unavailable. Running totals monitor progress toward match requirements. Track how much in-kind value you have documented compared to your commitment. Are you on pace to meet your match or falling behind? Early identification of shortfalls allows time for corrective action. Following best practices for in-kind valuation protects your organization and ensures your cost-sharing counts. These practices should guide your approach to all non-cash contributions. Use defensible methods by applying standard valuation approaches recognized in federal regulations. Reference market data, use established rate schedules, and apply methods that auditors will recognize as appropriate. Novel or idiosyncratic valuation methods invite challenge. Document thoroughly by creating comprehensive records from the start. Do not cut corners on documentation expecting you can reconstruct it later. Contemporaneous, complete records are far more credible and much easier to maintain than after-the-fact reconstruction. Be conservative when facing valuation uncertainty. If the appropriate rate for volunteer time could reasonably be $60 or $80 per hour, use $60. If donated equipment might be worth $5,000 or $8,000, claim $5,000. Conservative valuations are less likely to be challenged and leave margin for any adjustments auditors might require. Verify third-party values rather than accepting donor claims without review. Partners and donors may not understand federal valuation standards or may overestimate the value of their contributions. Review claimed values against market data and adjust if necessary to reflect fair market value accurately. Let us summarize the key points from this lesson on valuing in-kind contributions. In-kind contributions must be valued at fair market rates following federal standards. You cannot assign arbitrary values to donated time, space, equipment, or supplies. Valuation methods must be defensible and documented. Overvaluing contributions to meet match requirements creates serious compliance risks. Service valuation depends on the service provided, not the volunteer's regular compensation. A highly paid executive who volunteers for general tasks contributes at general service rates. A professional providing specialized services contributes at professional rates for that specialty. Match the value to the work performed. Documentation is essential for supporting all valuations claimed. Maintain records showing what was contributed, when, by whom, and how you determined its value. Without adequate documentation, valuations cannot be verified and may be disallowed even if the underlying methodology was sound. In our next lesson, we shift to multi-year budget forecasting. Grants spanning multiple years require thoughtful projection of how costs will change over time. We will explore strategies for planning budgets across project life cycles, including front-loaded versus steady-state approaches. Practice exercise. Identify an in-kind contribution your organization receives or might receive for a grant project. What type of contribution is it? How would you determine its fair market value? What documentation would you need?